Hi, I'm Aoife Devitt, and welcome to this week's Markets Happy Hour podcast. It is June 2nd, 2026, and I've entitled this podcast A Conversation in Clayton, because that's exactly what we're having. I'm delighted to be joined here in Clayton, Missouri, by my colleague, Cynthia Kirkpatrick, who is a senior advisor on my team within Moneta. And given that the whole point of this podcast is to translate macro events into easily identifiable and actionable actions for clients within their portfolio, no matter what their size, I thought it would be great to sit down with Cynthia and hear from her about how of the typical things we cycle through in this podcast are really being felt by your clients and how they matter and how they're thinking about them and responding. So as usual, we are going to cycle through the 5 topics of inflation, interest rates, geopolitics, equity markets, and other asset classes. And some of the subtopics I mentioned today, we will be looking at personal inflation gauges, because we all know what the top level inflation figures are. But in Cynthia's case, we're going to speak about how individual clients are experiencing inflation and how that may differ from the overall top line number. We're going to then move to interest rates. And again, because we are relating this to how individual clients work, we are going to look at mortgage rates and ask about whether mortgage rates are starting to make a difference to the client's desire to refinance a house, sell a house, and how that's all reacting. We are going to move then to markets and particular look at the wealth of money that is now in money market funds and ask how that relates to the current momentum in markets. We're going to speak about IPOs. There's a lot of interest among the private wealth community in this coming wave of IPOs, and we'll speak about that. And as always, this all relates to different portfolio implications. So we're going to be relating all of this to individual portfolios. So here is Cynthia. You can see her bio there, a long intro, but senior advisor on our team and also a fellow podcast host. So more on that later in terms of the She Lift podcast that she would. Welcome, Cynthia. Thanks for joining us here.
Thank you. I'm excited to, again, always hear you speak about everything that's going on so intellectually, but as you mentioned, relating it to the real world, because no matter what we do in life, even if we're advising people, we have to go through it too.
Exactly. And I think that is the point here, is like, how do we translate this into actionable advice for our clients, and how do we think that they are really digesting all of what's going on in markets? So the very first point, which clearly is something we all feel in our bones every day or every time we make a trip to the grocery store, is inflation. And the trend that I've been noting in terms of inflation, and it's on the chart behind here, is that inflation has been coming down, but it has kind of stalled at this last mile. We obviously did have the pressure at the gas pump I mentioned around the Strait of Hormuz, that being closed, and that was also trickling into fertilizer prices, to food prices, importantly. But one of the linchpins of inflation seems to have been that this the service price has still been pretty stubborn and hasn't been moving down. And then when we think about the individual client's experience, how have you been speaking with your clients about this? Because as the chart here shows, wages haven't really kept up. So the client may be feeling the pinch and when they go to the store, when they fill up their car, but equally they're not getting that uplift in their salaries. What are your clients telling you?
Yeah, it feels like a just dichotomy, juxtaposition of emotions, right? The markets are at all-time highs. You're being told everything's great. It feels great. At the same time, in real life, as you said, you're going to the gas pumps, you're going to the grocery store, and you're left with this whole other different feeling. So those contrasting emotions, I think, can be difficult, especially when those clients come in and want to know how things are going. And they're calling in talking about, or coming to meetings saying, my car insurance just went up a lot, my house insurance, my property tax. So we're not just seeing this in, going to the grocery stores, as you mentioned, and beyond the oil pump. It's all those other things that maybe we aren't faced with day to day, but when they hit big, like medical insurance too is another big one. We keep seeing that increase so much year over year. It goes directly to the bottom line.
Exactly. And obviously we've been looking at this top line figure, the Fed target of around 2%. We've seen inflation kind of hover closer to that 3% level. Would you say your clients' individual inflation that they're experiencing is higher than that 3%?
I think so. And, there's a lot more talk about when is it going to come down? When is this going to stop? So I think, again, you flow into so much of what we do is emotional, not just the technical. And of course, all the charts and everything are so important, but it's the emotional side of things. So that hanging on to, we thought this was supposed to end already. We were told that the rate of inflation would be coming down. Iran's here now. What's next? What can we handle next?
Right, and that, of course, is that emotional load, which probably gets to sentiment as well. I've been noting in these podcasts that consumer sentiment has been at an all-time low. And a lot of sentiment is driven by, I suppose, the expectation of what's coming next, as you mentioned, what is next. In some cases, that manifests in clients bringing forward expenditure, say buying that car now and not waiting for a year, or doing the renovation now because they don't want to think it'll be more expensive next year. Or it means that they may... Do they think things will be more expensive going forward, or are they trying to put money away for that rainy day because they're concerned? How do you see the behavior manifesting?
It's different depending on the situation. So I think as we talked or will talk about, mortgages and homes, if you downsize with the way rates are today versus what they might have locked in years ago, they're actually going to be paying the same or more for a smaller home or a smaller place to live. So you're not saving there. But when you think about maybe vehicles, they may think vehicles, the cost of those are only going up. I should go ahead and not only bite the bullet now, but maybe with the interest rates lower on vehicles, go ahead and buy that now and not wait. So I think it really depends on what area of life we're moving forward in.
But it's clear that there is definitely a mixed experience across the board. And that's a great segue into the interest rate discussion, because I think one of the biggest key changes this year is the 180 around interest rates, because we did seem to all believe that interest rates were coming down. And we know that after reasonable amount of time at mortgage rates around the 6% level and higher, that was definitely placing some kind of a brake on, as you mentioned, transacting or on home sales themselves. And it clearly was making the burden of mortgage rates quite a bit higher for anybody who had no choice but to have to change or to take on a mortgage. So that's been there. We know now that mortgage rates have climbed again to this other high, as mentioned here, that it's now in excess of 6.5%. So that's clearly getting to a level again that's more of a pain point. And it seems that rates are not coming down either, because inflation has been so persistent that the Fed just could not get away with further having an easier policy. So how do you think that affects clients? I mean, are they waiting for rates to come down, or are most clients kind of happily locked into a rate from years ago and not concerned?
I think yes, and I had clients who went ahead and said, you know what, I'm going to buy this home because I know in a year I'm going to be able to refinance at a lower rate, which now we're seeing may not be the case. There were some that said, I had a higher rate, I think I want to refinance. Is now the right time, or should I wait? Luckily on those, we went ahead and pulled the trigger because rates have popped up since then. And so I think it comes back to that uncertainty. We want to make decisions based on what we think is going to happen. And when we make that and these things change outside of our control, again, feeds back into emotions, and whether it's making the wrong decisions or not making any decision and just stalling, people are still waiting to see how this is all going to play out.
And they're waiting in size, because if we look at the amount of money that's now in money market funds, the so-called dry powder fund building up on the sidelines, 8.3 trillion, a new high, sitting on the sidelines. Clearly, cash is not a drag on portfolios today. If they're making a decent return, it's not phenomenal after inflation, but it's not like negative return that it would have been in the past. So how do your clients feel about cash? Are they happy to have some sitting there? And obviously you need to have some liquidity for various cash flow needs. But would you say there's a comfort level with having a certain amount of cash on the sidelines today?
They always want to know that there's something that they can easily tap in an emergency, whether it's that car, whether that's home issue, whether the prices are going up, whatever it might be. They want to know that they have a certain amount of that easy tappable money. And I think now more than sometimes it's, okay, I might be missing out a little bit on the upside in the equity market, but I know it's there. And if and when, because we're still in volatile times, the market comes down, then I'll feel my emotions around what I still have is a stronger emotion than the pain of losing.
Yeah. And obviously this wall of money is important because it's driving activity in equity markets, because we see this as being essentially dry powder that is there poised to enter markets whenever the opportunity presents. And I think this buy the dip mentality is pretty alive and well, coexisting with its cousin FOMO, the idea of fear of missing out. So therefore we have this cash on the sidelines, which is really making these dips in markets much more short-lived than we've seen before. This chart speaks a little bit about momentum and the semiconductors in particular, and just how the AI wave in markets has really led to this explosion of momentum. And clearly, this is not our grandmother's equity market that we're looking at today. It's a very concentrated market dominated by a few large players. And I'd say, just in terms of some other charts we've been looking at recently on this podcast, the dividend from equities have been essentially diminishing. It's not really an income play anymore. And equally, because bonds have looked okay, as we mentioned, cash looks okay, the equity risk premium seems to have come down. Are investors being paid to take risk in equities? And I suppose that's another question. And then when you think about your clients, and do they think about equities as something they want to know on a granular level, stock by stock? Do they think about it as just somewhere they get their growth from? How do your clients think about equities, and are they concerned about some of these things we've been mentioning?
I think overall they see equities as, and as we propose to them, this is the growth engine, the offense of your portfolio. And so it's much more of a broader basket discussion than it is necessarily stock by stock. Now, as you mentioned and referred to, there are certain stocks and companies that are more newsworthy, if you will, and they like to hear the news in that front. But I think when they peel it back to what's my portfolio, what are we doing, they want to be less about snazzy and having, those certain named companies. And again, as we've talked through, are you diversified? Are we rebalancing? Have we managed the risk as much as we can, knowing this is a long-term game, not what's going to happen in the next week or month, which unfortunately right now, a lot is happening in those short time frames.
Yeah. I think that's right. We mentioned we as investment professionals sometimes assume that clients do want to focus on the latest news story or the latest stock to cross the $1 trillion barrier or the latest NVIDIA release. But actually, the focus is much more holistic often in terms of, will there be enough in my portfolio to take us to retirement and beyond? And clearly that engine is a key part of that. The next slide I wanted to talk about was around these IPOs, because clearly there is a tremendous amount of noise and, I'd say, puff and excitement in the marketplace around 3 pending IPOs: SpaceX, which has already been papered and announced, Anthropic, which has just been applied for and announced, and then OpenAI probably following hot on the heels of Anthropic. And I suppose what surprises me a little, having come only in the last 5 years into private wealth, is just that the desire to participate in something which is probably pretty frothy when we think about the valuation that SpaceX is likely to come out at, and just the lack of, I suppose, identifiable revenue flows. But why is it that there's this desire to get exposure to these IPOs?
I think, the flip side, or part of the fear of missing out, right? Think back to just people in general, our general natures. We want to participate. We want to be a part of what could be that fun and exciting news story that everyone's interested in. We want to be part of the popular crowd, if you will, and not necessarily knowing often what happens with IPOs in the short time frame when it comes out. And so, gosh, our world definitely comes back a lot to emotions. Mm-hmm. And sometimes maybe we talked about taking action when you shouldn't take action. And just that kind of get in there and be a part of it.
And I think how much of the discussion is around this behavioral tendency, because there is, we mentioned FOMO, we mentioned this, the idea that, there's a need to keep cash on hand for a rainy day, but equally a desire to participate in the hot stock or the hot issue. And even to say you own a piece of Elon's dream, and that there's an element of that being exciting too. When you think about maybe AI more broadly, and this is, something that I think we are seeing as being really gone from a kind of a financial issue and a workplace issue to a moral issue, even around AI and its potential to displace jobs, its potential to disrupt humanity in many ways. And I've got some headlines here which were recent, but the Pope weighing in with his missive and his basically the idea that this could be the modern day Tower of Babel, and OpenAI now being in Florida, of all places, which I would think of being a fairly conservative state. Florida, a lawsuit against AI because of damage related to some of the, I think some of the therapy that was going on and some of the school shooting in that case. Do you feel your clients are taking a step back from AI and asking these questions?
Not particularly. Again, I think they hear the news, they want to be able to participate in some of those conversations when they're out. But when they come back to their own portfolio, we know AI is going to have an impact not only in the tech space, but, energy, data centers, construction, all of that. It's playing out throughout the economy. And again, I think they want to know at the end of the day, we can't predict everything. Have we diversified? Have we lowered risk to the extent possible? However, I still need to participate in the markets. I still need growth because, as we already talked about, there's that inflation humming along. We need to stay invested, and it's impossible to time and it's impossible to predict 100% of the time.
Yeah. And what I love about our interactions with clients, our meetings, is we're actually getting some intel in terms of whether it's the company that the client works at or just somebody from Main. We're getting intel from Main Street and not from Wall Street in terms of the usage of these models. And I think often the narratives around AI are woven by Wall Street titans who would have you think that, wouldn't they? Or by the insiders, when it's actually the use cases that we're seeing day to day. Do you see that some of your clients are either worried about their kids and them having graduate jobs? Are they seeing massive transformation in their own businesses from AI? Or are they kind of watching this happen and maybe not actually having that much change in their own lives?
I think it's a combination of a lot of them. Being a parent myself, I'm not even sure how to, a college-age son, 2 girls that are coming up behind that, I'm not even sure what to tell them or where to study. And I think we're certainly seeing some of those entry-level jobs, maybe a pause in hiring there because it will be about those younger people coming into the industry knowing how to use AI and making sure that as they're studying and as they're getting into the first few jobs that they are actually using it. And then I think exactly what you said, we've got Wall Street and these tech titans telling us how big and important AI is, yet on the real front, how much are we really using it? And I don't think it's to the degree that they're talking about it. Again, there's still talk about cybersecurity, controls, making sure that what we're getting from AI is actually truthful and double checking all that work. So I do think people who own businesses are working professionally, they're dabbling it, they're getting more involved, but it's not where one might believe it is based on the news.
And I suppose just as we conclude here, we always like to kind of bring this back to portfolio implications and thinking. And how do you find the mood, as it was, or the vibe check? If you were to speak with, we've gone through so many recession forecasts that never came to pass. We've had this elusive soft landing being discharged and executed by the Fed. But now we have this market's highs juxtaposed with consumer sentiment kind of eroding. How do you think, are clients concerned about their portfolio resilience? Are they putting some of those concerns into the back of their minds and just enjoying the ride? What would be, say, the vibe that you get from the client around the economy and their readiness for it?
I think so much of it depends on the client. How young are they? Do they know they have a long runway? They're typically willing and able to take more risk, to be more invested in the markets and companies that they hear about. How long have they been investing? If this is relatively new world to them, then they might be more fearful and afraid to put as much into the markets as they safely could. And they might want to pull back quicker and pull more off the table. If, for most of our clients who've been doing this for a long time, understand how it works, again, does not remove the emotions, but they understand how it works. We always go through something that scares the markets and pulls it back. If you have a well-constructed portfolio that brings in safety and growth and is suited specifically for them, their situation, not only financially, but emotionally, then they see where they actually take advantage of the pullbacks in the market because they have cash, not so much in a money market, that's not necessarily what we do, but they have fixed income that they can use as buying power so that when the market declines, we're buying on sale. So over the years, really talking through that thought process with them of, when the market's down, I know we don't like it, believe me, we're invested too, but this is on sale. This is our buying opportunity. When the market's up and you're going to want to put everything on black, then that's when we need to be selling those profits, because again, we've constructed this portfolio where we agreed your allocation should be, X, Y, and Z. And when it gets out of alignment, we're going to rebalance. And so it depends on the client, but I would say those who've been invested and those who've been in play for a long time, the game doesn't feel great all the time, but they know the game to play and that it works.
Now, that's great advice. A great reminder of the old dollar cost averaging and just assiduous rebalancing, that adage, which is actually why I believe that private wealth clients are far less like the hot money that they may have been decades ago, because I think they are being advised in the right way in terms of staying the course according to their investment policy and their investment objectives, and not moving around with the volatility of markets, although it can take a strong stomach at times. And I think we've all been there. We haven't had so many of those calls recently, but we've certainly all been there. Well, thank you so much, Cynthia, for giving us a snapshot from Main Street, as I mentioned, in terms of giving us the insight into how clients are thinking about these volatile and at times troubling times, but extraordinary times as well on the other side of the equity market spectrum. Thank you for joining us on the Markets Happy Hour podcast.
Thank you, Ethan.